This is Ask Todd on the Financial Exchange Radio Network. If you have an existing estate plan or are in the market for one, Todd Lutsky is here to answer your questions and help you plan for later life. Ask Todd is presented by Cushing & Dolan, serving Massachusetts and New England for more than 35 years, helping families with estate and tax planning, Medicaid planning, and probate law. Visit CushingDolan.com. Now, here's Todd Lutsky.
As promised, we got Todd Lutsky from the law firm of Cushing and Dolan with us now. The segment here is called Ask Todd because it is your chance to ask Todd your estate planning questions. I'm sure you might have some with the Trump election. Hey, what does the estate planning landscape look like for the future? How might it change? Give us a call at 888-205-2263. That is the number to call in order to speak with Todd about your estate planning questions. We got the phone lines open, again at 888-205-2263. Mr. Lutsky, how are you doing today?
I am doing great. You?
I'm good. Do you know why the lifeguard didn't rescue the hippie?
No.
Because he's too far out, man.
That's good.
Todd, I want to talk to you a little bit about gifting. We're getting towards the end of the year right now. And when it comes to the current state of being able to make gifts to individuals, what's the law of the land today?
The current landscape for making it doesn't matter the size of the gift. Are we talking about smaller or bigger gifts?
How much is allowed without having to pay tax? Like, what's the law of the land today?
That's fair because that really covers two questions. We'll try to take care of both of them. So one, many folks who don't really care about the impact of the gift, right? So if it's a present interest exclusion gift, today it's $18,000 per year per person. January 1, tax law change, $19,000 per year per person. I say these are the simple gifts and the freebies because they require no filing of a 709 gift tax return, no reporting to the IRS of any kind. You simply write the check and it's tax-free to the giver and, of course, as always, tax-free to the recipient. However, people say, well, what if I have a lot more money I want to give? What if I want to give away $100,000? What if I want to give away $1 million? Can I? Yeah. Now you move to what is called a taxable gift. So let's use $1 million as an example. If I had $1 million and I wanted to get it out of my estate, maybe it's going to bring my estate down to reduce my state estate tax. Maybe it's going to help reduce my federal estate tax. So I want to make this gift. And let's just say it's cash for now. If I move $1 million out of the estate, now I've made a taxable gift. Call it $1,018,000 so I can bring back in the present interest exclusion for you. If I give away $1,018,000, the first 18 I just said was a freebie. Now, you back that out, and the taxable gift is $1 million, and that gets reported on the 709 gift tax return that the giver files, not the recipient. Okay, now I've made $1 million gift. I don't want to pay tax on that. What's the bottom line tax due on that $1 million transfer? Well, it's going to be zero, but why? Because we now shift over to what is known as a federal gift tax exemption, which happens to mirror the federal estate tax exemption of $13,600,000 and change roughly today. Now, that's going up January 1 as well, but today that's how much I can give away. So if I have 13.6 and I give away $1 million, I just eat into that 13.6 by 1 million, leaving me an exemption of 12.6 and zeroing out my tax liability on that gift. So pretty easy to do. Can you give away more than $1 million? Sure can. The whole 13.6 if you like.
Talking with Todd Lutsky from the law firm of Cushing & Dolan. If you've got questions for Todd about your estate plan, we got the phone lines open here at 888-205-2263. That number again is 888-205-2263. Still got some room on the phone line. So again, that number is 888-205-2263. Todd, if someone is trying to incorporate a gifting strategy into their estate plan, what are some of the constructions that you've seen that could potentially be successful?
So there's so many things to think about, though, Chuck, but I'll just try and give you a quick heads up, right? Think about what you're gifting. Is it cash? Is it low basis stock that I bought years and years ago and I'm going to have a huge built-in gain? Is it rental property that I have had and depreciated the basis to zero with a huge built-in gain? So you want to think about the type of asset I gift. Gifting away high basis assets is better than low basis assets. So to the extent you can do that, do that. Like what? Cash or stock that I just bought that has a high basis. That way you're getting it out of your estate without incurring or trapping, I should say, a built-in capital gain. Because remember, folks, the capital gains tax that you're building in could be higher than the estate tax you're trying to avoid. Lots to think about, folks, for sure.
Talking with Todd Lutsky from the law firm of Cushing and Dolan. If you've got a question for Todd, we've got the phone lines open at 888-205-2263. That number again is 888-205-2263. We're going to take a quick break here, but when we come back, it's going to be right to your questions with Todd. Again, still a little bit of room on the phone lines at 888-205-2263. Quick break, then your questions with Todd.
Ask Todd with Todd Lutsky every Wednesday at 10:30, only here on the Financial Exchange Radio Network. You're listening to Ask Todd with Todd Lutsky on the Financial Exchange Radio Network.
All right, let's get right to the callers. Here we got Ed in Newberry. Ed, what's your question for Todd Lutsky?
Well, maybe I'm misunderstanding what you just said, but we have 5 kids. If I give each of them a $19,000 gift, or $95,000, I understand it's tax-free for them, but won't I have to pay taxes on that money when I pull it out of my account?
Well, if you pull it out of an IRA, yes. But if it's sitting in your investment brokerage account, no, right? Because distributions out of your brokerage account are not taxable. Now, if you have to sell something to liquidate the investment to generate cash, well, sure. You have a capital gain if you sell something, or a capital loss, depending on what you sell. But no, there's no tax on withdrawing money from your non-IRA account. It's just whatever you incur. So if you got a core account with cash sitting in it, you can give. And by the way, the 19 is next year. 18 is this year. So yeah, you can give away $18,000 per year per person. No tax for you, no filing for you, no gift tax for you, no filing for you, and no income tax or gift tax to the recipient at all. So hope that helps. Definitely have at that. But folks, you know, gifting is not easy. We're starting to learn this right now, just as we start to touch the tip of the gifting iceberg, if you will. We'll be exploring these all month long, but you can get ahead of the curve by getting the guide, making the most of gifting your assets. Don't make mistakes like, oh, I added a joint name to an account. That's easy. Was that a problem? I don't know. Well, I put a joint name on a rental property with my kid. I decided to put my kid's name on the property. Oh my gosh, did I make a completed gift? Do I have income tax problems? Did I expose assets to creditors unnecessarily? So many things can happen when you make simple moves or simple things that you think are simple, like gifting. Please learn how to gift the right way. Get the guide, 866-848-5699. or legalexchangeshow.com, making the most of gifting your assets, 866-848-5699 or legalexchangeshow.com.
Todd, I've got another one here for you. We've got Carol in Old Orchard Beach. Carol, what's your question for Todd?
Well, it's fairly similar, but I don't have $1 million to give someone. I'm probably going to have about that much to live on myself as I go into retirement.
Mm-hmm.
Hopefully that'll take me through.
Mm-hmm.
But my question is a smaller amount. If I want to give, like one of my kids, let's say $10,000, how do I do it so that I'm not taxed on that $10,000, and when I give it to him, he doesn't? You know, it doesn't add to his income, and therefore he gets taxed on it.
You're right. It was very similar to the last question, Carol, but that's okay. So let me do it this way. The $10,000 you're giving, is it cash?
Well, okay, I guess I've got to make myself clear. What if I write a check? I mean, yes, I can pull out cash.
Yes, absolutely. So all you need to do to accomplish your goal of getting that $10,000 to your beneficiary is simply go to your bank, write a check, pay to the order of, hand it to them. You do not need to file any federal gift tax return. You are not required to do it, nor do you have to. Secondly, so that means there's no gift tax for you. Your child who receives the money does not have an income tax liability because gifts are never an income taxable event. So doesn't matter how much they receive, the recipient has no gift tax and the recipient has no income tax. Simply write the check, and you can do that. So great question. Hope that helps.
Todd, we'll keep the train moving here. We've got Tom in Charlestown with a question for you. Tom, you're on with Todd Lutsky.
Thank you. Good morning. Todd, last week you spoke about leaving your IRA to your estate. And I have two questions about that. One is it subject to probate in order to get it out of the estate? And secondly, since it is subject to probate, if you find yourself in a situation where you qualify for Medicaid, but Medicaid is going to have a lien, will that lien attach to that IRA that you've left to your estate?
Great question. So two answers. One, in order to name the estate the beneficiary, yes, you are going to go to probate. No way to avoid it for that one item. Then that item, and again, that only happens when you die. So you have to be married. Let's say you pass away, Tom. You never went to the nursing home. The asset flows through probate into your testamentary trust. So yes, you have to have a testamentary trust in place as well to receive the money through probate. But then it is in trust for the benefit of your spouse who can enjoy the income and the principal. And the next day get sick and go to a nursing home, and it is immediately protected from the nursing home. And lastly, there will be no lien on that money. So it really is a home run for the one bad part. I got to go to probate. But the pros, in my mind, generally outweigh the cons here. So hopefully that helps.
Todd, I've got another one for you here. Let's go to Steve in Maine. Steve, what's your question for Todd?
Yeah, hi, Todd. I have a question for you. So my mom has owned a beach home for about 30 years. It's not her primary residence. It's worth a little under $1 million. And after she passes, she's giving it to my brother and I, but she just wants us to sell it, just so we don't have to share it, which is challenging. Would it be better taxes if she were to sell it before she passes, or would it make any difference?
Yeah, it'd be horrible. Horrible to sell it before she passes. So please, folks, this is exactly what we talk about. 30 years ago, she bought this property. I don't know. Maybe she paid $100,000 for it. Maybe she paid $50,000 for it. Say $100,000. We've got $900,000 of built-in gain here. You give away an asset like this. When I talked earlier about high basis and low basis, right? This is low basis. You give this away, you're trapping $900,000 of gain during life. Don't give it away. Don't sell it during life because you got the $900,000 of built-in gain to pay tax on. Instead, hang on to it, right? Plan for it. Put it in a trust, whatever you want. Die owning it. And when you die and it passes to you kids will now get it with a brand new basis of $1 million, fair market value, date of death. It eliminates the built-in gain. Sell it. You guys pay no capital gains tax. Or if one of you want it, buy out the interest of the other one. You have every option available to you. Don't just sell it or give it away now.
Todd, any other final thoughts on gifting? We got a little bit of time here. Any last thoughts before we wrap up?
Yeah, I think I just want to spend a little more time on Steve's question, just because I didn't know if there was another caller. But on Steve's question, again, folks, this, if you have the time, right, you should not just not give it away, but stick it into an irrevocable Medicaid trust. I don't know how old she is, or he didn't mention anything about her health, right? If we have time, I would put that into an irrevocable Medicaid trust so that I can get a clock running so that, yes, I'm keeping it, but I also don't want to lose it in case she needs long-term care before she dies. This kind of irrevocable trust, unlike gifting trusts, will allow the asset to be protected and included in the estate when you pass away, therefore still preserving that step up in basis I just talked about for the kids, who then can sell it with no capital gains tax.
Mr. Lutsky, thank you so much for joining us today. We appreciate the time.
It's always a pleasure. Thank you.
This has been Ask Todd on the Financial Exchange Radio Network. Ask Todd with Todd Lutsky has been presented by Cushing & Dolan, serving Massachusetts and New England for more than 30 years, helping families with estate and tax planning, Medicaid planning, and probate law. Call 800-393-4001 or visit CushingDolan.com. The views expressed in this segment are solely those of Cushing & Dolan. Armstrong Advisory does not provide any legal or tax advice. Please consult with your legal or tax advisor on such matters. Cushing & Armstrong do not endorse each other and are not affiliated.